The stock is trading at exactly $13.16 right now, down a sharp 1.40 points, or 9.58% for the day. If you are looking at your screen and feeling a pit in your stomach, you are not alone, because a near 10% haircut in a single session is the kind of volatility that tests the resolve of even the most hardened crypto equity veterans. But before you react, before you hit the sell button or double down, you need to understand exactly what is happening beneath the surface of Cipher Mining Inc. today. The expectation coming into this week was that the massive tailwinds from the broader tech sector, specifically the artificial intelligence boom and the residual heat from the crypto rally, would keep miners like Cipher pinned to the ceiling. The expectation was that the recent announcements regarding high-performance computing contracts would insulate this stock from the day-to-day erratic behavior of Bitcoin's spot price. The reality, however, is far more nuanced and aggressive. The market is currently punishing the stock not because the business model has failed, but because of a classic sell-the-news event combined with the digestion of capital structuring that short-term traders hate but long-term investors usually tolerate. What we are seeing at $13.16 is a violent repricing of risk. The market is forcing you to ask a difficult question. Is Cipher Mining a Bitcoin proxy, or is it a budding AI infrastructure giant? Today's price action suggests the market is confused, and in that confusion, there is a massive divergence between price and value. While the retail crowd on the Robinhood app might be panic selling because they see a red percentage, institutional desks using interactive brokers' trading platforms are likely looking at the volume-weighted average price and calculating their entry points for the next leg of the cycle. This drop is not a simple liquidation. It is a stress test of the company's recent pivot to high-performance computing, or HPC. When you look at the intraday chart, the selling pressure has been relentless since the opening bell, pushing the stock through key support levels that had held firmly earlier in the week. This 9.58% drop is significant because it wipes out days of accumulated gains, resetting the technical posture of the stock. You have to look at the volume accompanying this move. It is heavy. It is decisive. This tells us that this isn't just a lack of buyers, it is the presence of motivated sellers. But why? To understand this, we have to look at the macro picture. We are seeing a cooling off in the speculative fervor that drove assets like Tesla stock and Nvidia stock to dizzying heights recently. When the leaders of the risk-on trade sneezes, stocks further down the risk curve, like Cipher, catch a cold. Furthermore, the correlation between Cipher and Bitcoin remains a tether that the company cannot fully cut despite its best efforts to diversify. When Bitcoin struggles to maintain its momentum above key psychological levels, the miners, which act as a leveraged bet on the underlying asset, often face exaggerated downside. It is the double-edged sword of individual brokerage accounts holding these stocks. They offer amplified returns on the way up, but they inflict amplified pain on the way down. However, if you zoom out from the one-day chart and look at what Cipher Mining actually is, the picture changes. Most people think of this as just another company solving algorithmic puzzles to earn digital coins. That is the old expectation. The new reality is that Cipher is effectively an energy infrastructure company that happens to monetize its power capacity through Bitcoin mining and increasingly through hosting data centers for artificial intelligence. This is where the comparison to Apple stock becomes relevant, not in terms of product, but in terms of ecosystem control. Just as Apple controls its hardware and software stack, Cipher is attempting to control the critical power stack that the AI revolution depends on. They have secured massive power purchase agreements at a time when the electrical grid is becoming the biggest bottleneck for tech growth. Let's talk about the specific catalyst that is likely weighing on the stock today. In the world of online investment, nothing scares a short-term trader more than dilution or debt offerings. Cipher has been aggressive in securing capital to fund its expansion. Building out data centers, specifically those capable of handling the thermal load of modern H100 or Blackwell GPUs, is incredibly capital-intensive. It requires billions, not millions. When a company announces that it is raising cash, or when the market sniffs out that more capital expenditure is coming, the immediate reaction is almost always to sell the equity. Investors worry that their slice of the pie is getting smaller, or that the company is taking on too much leverage. This fear is what is driving the price down to $13.16 today. It is a mechanical adjustment to the balance sheet realities. But here's the contrarian take. If you believe in the thesis that compute power is the oil of the 21st century, then Cipher raising cash to build more oil rigs is not a bearish signal, it is a necessary step for massive growth. If you are using Schwab Intelligent Portfolios or managing your own Fidelity investments, you have to decide if you are renting this stock for a trade or owning it for the thesis. The trader looks at today's drop and sees a broken trend. The investor looks at the drop and sees an inefficiency. Consider the recent moves by SoFi stocks and other fintech players who are trying to democratize access to these complex assets. The narrative they push is one of accessibility, but they rarely explain the operational complexity of a company like Cipher. Cipher operates industrial-scale data centers in Texas. We are talking about facilities that consume hundreds of megawatts of power. In the energy market, they engage in what is known as demand response or curtailment. When the grid is stressed and electricity prices spike, Cipher shuts down its machines and sells the power back to the grid. In some months, they can make more money not mining Bitcoin than they would have made mining it. This is the hidden hedge that the market often ignores on red days like today. They are an energy arbitrage hedge fund disguised as a crypto miner. Let's go deeper into the AI pivot, because this is the friction point between expectation and reality. The expectation is that pivoting to AI is easy. Just unplug the ASICs and plug in the GPUs. The reality is that it's an engineering nightmare. AI clusters require different cooling, different latency standards, and different redundancy architectures than Bitcoin mining. Bitcoin mining is interruptible. If the power goes out for 10 minutes, you just lose 10 minutes of hashing. If an AI training run loses power for 10 seconds, you might lose weeks of work. Cipher's ability to secure contracts with major hyperscalers suggests they have solved this engineering problem, validating their transition. This is why you see institutional flows from places like Fidelity Brokerage and Fidelity Wealth Management divisions starting to pay attention. They're not buying a miner, they're buying a PowerShell with a proven management team. Speaking of management, we need to discuss the ownership structure. When you look at institutional activity, you often see a divergence from retail sentiment. While Robinhood crypto traders might be fleeing the scene today, we need to watch the 13F filings that will come out in the next quarter to see who bought this dip. Smart money, the kind that uses interactive broker stock trading for execution, tends to accumulate shares during these volatility flushes. They understand that the spot price of Bitcoin is volatile, but the value of a 300 megawatt power interconnection in West Texas is only going up. Regulatory pressure is another wet blanket on the stock today. There is constant chatter in Washington about the environmental impact of mining. Every time a headline crosses the wire regarding a potential tax on energy usage or a review of grid stability, stocks like Cipher take a hit. But you have to look past the headlines. Texas needs miners to stabilize its grid. The miners act as a flexible load that incentivizes the build-out of renewable generation. Cipher is at the forefront of this argument, positioning itself as a grid stabilizer rather than a parasite. Now I want you to take a second and engage with this idea. Comment below how many shares of Cipher Mining you currently hold, And more importantly, tell me if you bought this stock for the Bitcoin exposure or the AI data center exposure. I want to see where the conviction lies in this audience. Are you here for the digital gold, or are you here for the compute infrastructure? Let's pivot back to the technicals at $13.16. We are sitting at a precarious level. If the stock closes near the lows of the session, it paints a bearish picture for the immediate future, suggesting that the sellers are in total control and will likely push for lower prices at the open on Monday. But if we see a late-day bid, a hammock reversal, where buyers step in at the close, it would indicate that the 13 level is being defended by large algorithm programs. Online investing has made it easier for retail to participate, but the heavy lifting is done by the algos. You need to watch the volume into the close. If volume spikes on the bid side, it's a sign of accumulation. If it spikes on the offer side, it's a sign of capitulation. The comparison to Fidelity ETFs and Fidelity mutual funds is